Yeah, exactly. $72 spatula.
Okay, it's being recorded. Don't say anything
Stop talking
not
about
cool.
We are
spatulas.
recording. You're on. You're live, Avery. And I totally forgot to make everybody admins. Oh boy. There's Derek. There's Brenna. I need Julie. She's good at it. Julie.
You know, you can search the names.
Oh, you're right. Look at you. See, I told you were good at it. Oh, let me turn my music off. I know Avery doesn't like that. She probably can't.
Well,
It's okay. Defend yourself.
it just sounds like noise. Like we
Yeah.
can't hear what it is. It kind of gives me a headache.
It was Elton John's "Step Into Christmas" is what it was. I think that's the name of the song. Yeah. All right, everybody. Hey now. So just wanted to give like a cool, like a overview of lending, because in my opinion, lending is the biggest piece of the entire puzzle. It's the most important part. Without the loan, you cannot build wealth, in my opinion, because it's all about leverage, of course, according to the purple Bible we use around here in the world of investing, and Mr. Kiyosaki. So to me, the biggest piece throughout my career has always been, how do I get this loan? How do I get this loan? And then getting the loan has always been more important to me than finding the deal. Honestly, that always just kind of falls into place. I mean, there's been times where Avery and I, and I'll introduce everybody here in a second, accidentally ended up applying for a loan. For whatever reason, we pulled credit for something else, and then decided, you know what, we probably should use that credit pull, and applied for a loan. And then we said, okay, we better use this on something. And then the deal came afterwards. So I find that lending is also one of my favorite parts. I've always been extremely interested in this, and I've always had a very serious knack for educating myself on the subject. And with that, I will introduce myself. My name's Luke. I co-founded the short-term shop with Avery back in 2016, 17. And I personally own 103 doors as of right now. And I'm financially free at the age of 41, and it is amazing. I love it, and I like to share my stories with other people, because I want you to have what I have. And what I have is, I looked at myself in the mirror. I don't remember when it was. I know it was 2 houses ago. I think I was 38, and that was the moment that I knew. It snapped. It said, I am now financially free. And what that means to me, guys, is I got to a point where my properties were buying my properties, and that was, to me, that was a bigger deal than like 10K a month or cash flow goals. But anyway, I will also introduce the boss. We'll go straight to Avery Carl. Avery, I think today we're asking you to speak a little bit more from an agent standpoint than from what you are, which is all encompassing, badass of all real estate, including author of the book, and etc. So Avery, tell us a little bit about yourself, and specifically your real estate agent career.
All right, guys. So I'm a real estate investor, obviously, like Luke, and we share a real estate portfolio. We have just over 100 doors. So that is my personal experience with clients. We are at like over, I think we're pretty close to 3,000 transactions. So I have seen it all when it comes to real estate transactions, and how lending can and will go sideways if you try to skirt the rules, or how things can go sideways even if you do everything right, like if you get a wacky appraiser. So I've seen everybody do every strategy in the book, some more successfully than others as far as lending goes. And I guess that's about it, Luke.
Yes.
There's something specific you were fishing for me to say.
I was, and that is the fact that you have been one of the biggest real estate agents ever, year after year.
About ever.
Since you start, well, in whatever year that was, since you started your career, Avery's the best in the business. We all know that. So we're going to have Avery speak from an agent standpoint today. And of course, we have Brenna, who is a co-owner of the mortgage shop and a total rock star in the lending world. And she's an actual licensed badass as far as lending is concerned. So Brenna will take that role today and introduce yourself.
Hey guys, my name's Brenna. I'm the CEO and co-founder of the mortgage shop, and this is all things lending. I'm so excited. I'm nerding out to be able to talk to you guys about guidelines. That's what I specialize in. Lending was not my background. I used to be a professional singer. When I started out in lending, I didn't even know how to work the printer. So I promise you, if I can get into it, you guys can get into it. So I'm excited to talk to you guys, and I will be here for all lending questions.
Brenna also has one investment property of her own as she's beginning to grow that side of her life, and we're very happy for her. And we do have several other rock stars in the room on the panel. We will, of course, go to Julie, who is, as I always say, one of only 3 people that I will take actual rental, host advice from. Julie McCoy, who is a rock star. Tell us a little bit about yourself.
Well, thanks. Now I've got competition. I thought I was the only one you take advice from.
Most important one.
So, hey, everybody. I am Julie. I have been a overnight rental investor since 2017. I was one of Avery's early clients, and just being a part of what she and Luke are doing in the short-term shop has really turbocharged my investing and journey to financial freedom. So I have learned so much from them, and I'm excited, and I continue to do so. So excited to be here and share what I know.
And now we will go to one of the other of the 3 people that I actually take host advice from, which is Mr. Chuck Kramer. Chuck's been around for a long time. He is not, as far as I know, I don't think professional of any kind just yet, but he is coming on board with the shop in the new year in Destin. So Chuck, tell us a little bit about your portfolio.
Well, we're up to 10 doors, 6 of which are short terms. And we've been at this for several years before it became the thing to do. And I don't have to work. I just choose to work because I like what I do.
Yeah.
On the side, besides real estate, we also have a restaurant in Sevierville for all you Smokies investors. So it's over in front of Lowe's, which if you own there and you visit there, you're going to spend a lot of time at Lowe's.
Yeah.
So
that is definitely a fact.
Yeah.
And then we'll go to Derek Tellier, who is another, well, first and foremost, a rock and roller, and been in Avery and I's lives for quite some time, and an absolute rock star of an agent. I think he's #1 in Gizmar right now, and probably will be #1 for the year, from what I understand. So, Derek, tell us a little bit about yourself.
Yeah, I met Luke and Avery back 8 years ago, 7, 8 years ago, probably. Luke and I had other mutual interests. I didn't know anything about real estate back then, but we liked Harleys and we liked rock and roll. So that's how we connected. And it took a few years for him to beat into my brain the benefits of real estate. It took a while, but eventually I got smart and bought a couple of long-term rentals, or bought a long-term rental, converted a primary to a long-term, decided I was sick and tired of the W-2 life, and joined the team about almost 2 years ago now, and it started to explode. So in the past year and a half, roughly, I went from having 2 single families to I now own 14 investment properties. 11 of them are short-term rentals. Done that all pretty quickly, and just, yeah, blowing it up, man, having a good time. I recognize a lot of names on the call. Some of you guys I've worked with, some of you I've just started working with. I saw somebody a minute ago that I just talked to like 5 minutes. There's Allison right below me. I see her. Just got off the phone with her right before we got on this call. So.
All right, cool. And Tim, also, not necessarily as much of a rock and roller maybe, but a badass in the car and motorcycle world. So we'll count him in on the rock and roll thing, but also owns a lot of rental real estate. And tell us a little bit about yourself.
Well, thank you. So yeah, I'm Tim Grillo. I was actually a former client and now an agent. Got some about 11 long-term doors, and I was actually one of Julie's clients before. And Julie taught me everything I need to know about this stuff. And now we just closed on number 5 of our short-term portfolio actually yesterday. So, and we closed on that with Brenna. So this is pretty cool to be here. So it's been a cool journey.
And you do have long terms as well.
We do 11 of them.
11 of them. Yep. So, and just to be perfectly clear, here at the shop, we only sell short-term vacation rental properties, but we are very pro long-term rental. We think it's a wonderful idea. And that leads me to now our last guest for the day, which is just a buddy of mine and a badass attorney. He is here out of the kindness of his heart, offering his time for free, which is not normal of a lawyer of his caliber. So everybody, please be easy on him. Mr. Patrick, who is, by the way, also an investor. Tell us a little bit about your portfolio.
Sure. So we've been an investor since 2019. We currently have 11 single-family long-term rentals, one short-term rental we just closed on with a short-term shop, and one absolute triple net industrial property in the Birmingham market. I've been a practicing attorney for 11 years now, and I specialize in asset protection and estate planning.
Patrick, great to have you. He also has a newborn, which is wonderful. Good-looking kid. Okay, cool. So we'll take over. I'll take over your screens if you guys don't mind. We're happy to have you here. Hope you learned something today because I mean, this is very nerdy stuff, but I find that it really is the most important part of the whole piece of the puzzle of the pie. Get your pie, man. So. And again, we're going to take this from basically you've got different perspectives on this call. It's kind of be the whole vibe here. I'm going to start the chat with what I think from an investor standpoint, and then we'll pass it to Brenna, and she can definitely give you more of a, hey, this is a cut and dry exactly how this stuff works as far as the book, buy the books. And then everybody else will throw in some opinions, and of course we'll close the show out with some question and answer. So please write down your questions as you go. And as always, of course, talk to your lender and your lawyer. Again, I'm not a licensed anything personally. I'm just a guy that owns a lot of real estate. So definitely consult a lawyer. Lawyers are not cheap. You definitely, if you're in a situation like what we're talking about today, talk to a real estate attorney. And these folks are not inexpensive. So do as much research as you can, and really figure out what you're looking for, what you need out of life. This question comes up all the time, and it's not necessarily what we're here to talk about today, guys, but it is lending related because of how you're holding properties. So I do want to touch on LLCs, and then I'll turn it over to both Brenna and Patrick from the expert standpoint. So as an investor, the way I did it, again, this is not legal advice whatsoever. I feel that you may not necessarily even need an LLC until you get to the point where you've got a lot of equity or a lot of cash. Now, this is coming from a guy who started with nothing. And I want to be perfectly clear about that. When I started this journey with Avery, it was a very humble situation. We did not have a lot of money. In other words, we didn't have anything to protect. So when we started buying properties, we felt very comfortable with insurance. And we did shortly thereafter get an umbrella policy, which is basically an extra insurance policy that will kind of hang over the top of your properties like an umbrella. And you do need an umbrella for your properties, which would be a commercial umbrella in most cases, and that will be state by state in most cases. Again, not speaking by an expert. So if you have properties in more than one state, I do recommend you get an umbrella in more than one state to protect each of those properties. Then you probably would want to look into a personal umbrella, which is, again, it's going to hover over the top of the assets that like where you live and the car you drive. And I will tell you right now, there is a 93% chance, and I think I stole that number from Patrick, that if you get yourself sued in any situation, it was probably your fault, and it will most likely be like a car accident type of a situation. Anyway, you are 93% more, I made that number up or heard it somewhere, more likely to get sued by hitting somebody with your car than somebody renting your property. But of course, you do need to make sure you're protected. So my thoughts on that, again, as not an expert, as just an investor, are that you should possibly maybe look down the LLC, go walk down the LLC road when you've got a decent amount of cash laying around, or you've got a lot of equity sitting in these properties, something that is worth being sued over. Then it's time to talk entity structure. At this point, you're going to want to do a lot of educating before you even get to a lawyer, because that lawyer is going to cost a lot of money to get all this stuff figured out. So you do need to figure out the differences between series LLCs and holding companies, and whether or not your state even is a possibility to do a series LLC. All these types of situations need to be discussed with a high dollar professional, quite frankly, which is not me. So I will turn it over now to, let's go to Brenna first. Brenna, let's talk briefly about your standpoint, and we'll get into the specifics of the different types of loans, but where do you stand as a lender on whether I'm trying to finance a property in an LLC or not?
So whenever somebody is like, oh, can you do a loan in an LLC, and it's their first time buying a property, I'm always like, what's your reasoning for purchasing in an LLC? Are you going in with a partner? You're doing a partnership because you want equal skin in the game, or are you just trying to protect your asset or asset protection? Because most of the time, if you're just starting out, I recommend, probably doing it in your personal name, because you can have an umbrella policy over your properties. Now, when you get into like 10 to 15 properties, then you can talk to your CPA about possibly opening up an LLC or a partnership or what have you. I usually work with you guys for long-term goals, short-term goals, and long-term goals, but I can't advise you to, open up a new LLC and stuff like that, as I am not an attorney or a CPA. And so I just kind of look at your situation and offer you my advice of what I think about your situation. But a lot of people think that you have to put your property in an LLC to protect it, and that is just not the case.
I'm muted, and now we'll turn it over to the real estate investor / professional lawyer. If you could give us a couple of minutes of your time on your thoughts on the subject.
Well, you want to protect yourself, number one. And you're going to get better terms if you're getting your loan not in the LLC. If you're getting in your personal name, there's better terms out there. With an LLC, what you're getting is protection, which is exactly what Brenna said. And if you get in that car wreck that you're talking about, you're actually much more likely to get sued in a car wreck. You own that in your personal name. Well, now that house that you own in your personal name can be gone after with a sheriff's cell. If it's in an LLC, the worst they can do is try and get a charging order and hope that you take money out of the LLC. That's the reason for putting stuff in an LLC, is for an asset protection standpoint, because we want to protect that asset. We want to make it where you're basically judgment proof, because people are very litigious in this world. There's lawsuits filed every day, and different areas are more litigious than others. And I actually had a client. I settled the case. I actually got it thrown out of court recently. But the guy owned 300 properties, long-term rentals in Tuscaloosa, Alabama, and they were all in his personal name. He owned them personally, and his insurance didn't cover anything because this was a mold case, had a mold exclusion. So, luckily for us, the attorney on the other side screwed up, and he thought it was a corporation, and so they sued a corporation. Statute ran, then I got it thrown out because they sued the wrong person.
But you got lucky. So, but yes, and again, it's the guy that's got 300 doors. Definitely needs to be having some asset protection. So that was a big mistake on his part. And really, guys, we don't want to dwell on that today. That's not what today's topic is about. But we will move on now to loans. Let's talk conventional. Conventional means that it is Fannie and Freddie, basically. You got these government organizations that it's basically they're making sure that weird stuff doesn't happen and the economy stays where it should be, et cetera. And these loans need to conform, basically, which makes them conventional loans. And you can have 10 conventional loans per person, or if you're married, you can have 10 each. So 20 per married couple. I call these the golden ticket of real estate. If you're just starting out and you've got a decent W-2, these things are They're worth their weight in gold. And these are the, these 20 loans, you really want to take advantage of these things over the course of your life and use them. I think you should have them all used up if at all possible. And doesn't mean you need to use them all up front. I definitely, I found that it was, for me, the best way to start was with conventional loans. You do have a limit as to how much the purchase price can be. It needs to be under, again, I have this in a future slide, but what's the number, Brenna, for conventional?
647.2 is the new loan limitation.
647,200, is that correct?
Yes.
And that's the loan amount. So the purchase price is in the low 700, mid 700s.
Yeah, like 720 something, I think.
Over that, it gets into jumbo, which we'll cover here in just a little bit. But use these things wisely. You can also use them for one to four family. So you can use a conventional loan on a duplex or a triplex. And these are going to be your lowest interest rates. They're, again, backed by these federally regulated organizations called Freddie Mac and Fannie Mae. And they are, in my opinion, the best way to get started in real estate investing. And Brenna, can you touch on these loans a little bit more in depth?
Yeah, so the 10 conventionals per person, anything over 6 finance properties in your personal name, you do have to have a 720 median credit score. So just keep that in mind when you're getting financing above 6 finance properties. And Luke is correct where it's 20 per married couple, but you have to strategize that. So it can't be like 20 loans in both of your names. You, as like the husband or what have you, have to go get 10 mortgages and not have the wife or your spouse or whomever on that mortgage with you. They can be on title, but they cannot be on that mortgage. And then if they can qualify for 10 others, they can go get the 10 others in their name, and vice versa, that husband or spouse will be on that title. And that's how you can do the 20. So you want to work with a lender that understands that and then will not screw you over, because if you and your spouse apply on a loan together and then you guys go and apply separately, you 100% will be accounted against that debt. So a lot of people think, oh, it's only half of my debt. Nope. If you apply by yourself, it's going to show as your full mortgage payment, no matter who, your wife or you, splitting that cost. So just keep that in mind when you are doing those loans.
And along those lines, there's really no reason to put both names on the loan unless there's a situation where you need the income from both people to qualify for that loan. At some point, if you do want to be, a little deeper into this business and maybe be full-time someday, you're going to want to refinance that thing at some point, likely, so that you free up one of those conventionals. But again, if you get that deep into it where you're hovering around 15 to 20 conventionals at any given time, you're likely to have moved on to a different type of loan. And but it is always nice to have a conventional in your back pocket mostly because of the low interest rates. Now, I will also throw in there, as an investor, these loans are a lot of freaking paperwork, and it gets to the point. This is where I'm going to call on one of our probably, let's go with Chuck on this one here in a second. But I mean, these, in the early days, you don't care because you're excited. You're very, you're eager to give them, because they're asking they want to know where you pumped gas 2 weeks ago and how much you pumped. You know what I mean? I mean, not literally, but it's pretty brutal, the amount of paperwork they're looking for. You get deeper into your career and you get a machine rolling where you're just closing deals like crazy. You don't really want to deal with all that paperwork anymore. So keep that in mind. But again, the low interest rate is the beauty of a conventional. And more importantly, the biggest part of it, 30-year fixed. It's the only place you're going to get 30-year fixed money, pretty much, period. I mean,
That's not true, Luke.
Go ahead, Julie.
I'm like, there's DSCR loans that
we
are
haven't
not
gotten to that.
conventional, and you can get 30-year fixed on that.
Yes, you can get 30-year fixed on DSCR. We'll get to that for sure. Now, higher interest rate on those. But Chuck, talk to me about the paperwork.
Well, incredible is a good word for it. And a pain in the rear, keeping this family friendly. But the first 2 or 3 that we did, and I just remember lots of nightmares, and we actually lost 2 deals in the beginning because of the amount of time it took. The repetitiveness, it was just ridiculous. It took months. We eventually moved to doing commercial loans. So with some of the larger people in the industry, it was a little bit better. The paperwork was streamlined, but the amount of time took longer. Instead of 30 to 45 days, we were looking at 4 to 6 months. These guys just weren't ready for this kind of business, and they weren't set up for it. Most of them were using people from the residential side who had no clue what to do on the commercial side. Nowadays, we're using DSCR loans, and I know we'll get into that later, but it's a world of difference. Interest rates keep going up as you move through these, but there's a point at which there's a question you need to ask yourself, am I going to lose the deal? I'd rather get the deal and be paying 5% than lose the deal.
Absolutely. Well said. Well said. So let's talk second home vacation loans. We'll get into DSCR here in a second. Again, these are conventional loans. The way I look at these guys personally, again, as an investor, and then I'll turn it over to Brenna. This is not, for me, this is not for investing. This is for a second home. You do need to have a decent, like a pretty decent day job, a W-2 that can back up the mortgage on this house, whether you rent it or not, because technically you're really not supposed to be renting it. That being said, yes, you can put a second home on Airbnb and Vrbo when you're not using it. So these loans, again, very low interest rate, very low down payment, but it's not for investing. So if you've got the big day job to back it up and you want to throw it on Vrbo when you're not using it, absolutely. But that's the way I look at these. It's definitely not a scalable model. And then I'll turn it over to Brenna.
Yep. So basically what Luke said, your first intention for a second home or vacation home has to be that you have to want to vacation there. I see a lot of people do this for the area. Like Luke always says, where does your wife want a vacation? That's where you're going to buy your first property. And so it's really true. And if you guys are first time investors, I recommend, doing that loan in a place that you want to visit, because one, you're getting used to the area. You can, recommend restaurants like the diner, Chuck's Diner near Lowe's. Y'all can get all your shopping done in one. And that way it's more personable. Like I know Luke and Avery have on theirs, like where you can, their favorite hiking trails in the Smoky Mountains and such like that. You want to know the area. You don't always have to know the area, but it is more personable. The guideline everybody always asks me, they're saying, well, how long do you have to stay in that second home? Well, first, again, ask yourself if that's the main reason you want to do it. And second, it's really a gray area. So I define it as 15 days out of the year is when you need to spend time at your vacation home. And when you are not using it, you can rent it out on Airbnb, VRBO, personal website, or what have you. Just make sure your first intention is for it to be a vacation home. You sign this thing called an FBI occupancy certification when you do a loan, and it's saying that I intend for this to mainly be a second home vacation home loan. So just keep that in mind.
I did it again. Yeah. So investment loans versus it's still a conventional loan, Brenna, but tell me what the difference is basically. Okay, so I guess we didn't really even touch on primaries because that's not why we're here. But I guess, can you give us the specific example of what the difference is between a primary and investment? To me, I guess I'll touch on it from an investor standpoint. This is your golden ticket of a house that you don't live in, right? So it's a 30-year fixed, going to have a pretty low interest rate. But again, it's going to have ridiculous amounts of paperwork. So in a lot of cases now, this DSCR is probably going to be a better option. But slightly lower interest rate on an investment conventional, Brenna, or where are we at on that?
Yeah, so primary residence obviously is what that is for you to live in as your primary residence. Second home loan is what I just described. And then an investment property is you mainly want to use it for an investment. You can actually use proposed rental income from the property you are purchasing to offset that monthly PITI, which means principal, interest, taxes, and insurance, if you own your primary residence. So Fannie Mae has this weird thing about you have to own property. And I actually looked at the guidelines because I had one borrower that rented their property and then had mortgage experience. And I believe that it's just that you have to own your primary residence. It's weird. They want you to own it and not rent it out to be able to offset that principal, interest, taxes, and insurance. That lowest down payment for conventional is 15% down. So not much more than the 10% down. You're able to use that income to offset your debt. It's a great product.
Again, you can do 15% down on an investment conventional, unless it's, again, correct me if I'm wrong here, unless it's more than one door. If it's 2 to 4 doors, it would need to be 25%.
Yeah, some people will allow 20. Some people only do 25%.
And going back
But-
to, oh, sorry, go ahead.
All right, when we get to the DSCR loan, they don't care if it's a multi-unit. It is just 15 to 20% down for that.
So again, second home, vacation home, I can't put a lease on it. Is that correct?
Correct.
And I also cannot, I believe the term is give up control of the property, which means no property manager. Is that correct?
Absolutely correct.
Right. That's where the Airbnb thing is, because if you're doing it yourself, there's no manager involved. But again, not the primary use of that loan. Commercial loan. So this is a commercial loan, and I'll go to Tim on this one. I know you started your career with commercial loans, and to me, I love these. This is a big part of my career. But again, it wasn't really until I got to like 50 something doors before you kind of get your foot wet with this. This is where you go to a bank, and they're literally lending you their money. So the bank is getting deposits, as in savings account money from other people in the community. These are generally very small community banks. I usually look for banks that have 10 to 15 locations. Any more than that is probably not something I'm interested in. I do business with a bank that only has one location. That is maybe not something I would recommend either. I like that 10 location area. And again, these are going to have higher interest rates, and these are what you would hear referred to as like an ARM. Right now, a lot of terms you're getting on commercial is a 5-year fixed at a 20-year amortization, and this would be more like for multifamily or somebody who's used up all of the conventional loans, or somebody who really if you're doing single family, if you're doing short term, I think the DSCR is a much better option. This would definitely be more for multifamily when it gets to that point. But you're literally walking into a bank, creating a relationship with that bank. They generally like what they mean by relationship is they like it when you put a lot of your own cash in the bank, and you oftentimes will get the vibe that they're almost kind of lending you your own money. But you'll get the person who works at the bank's cell phone number. You can call them up. This is a little bit deeper in your career. You get to be a little bit more of a baller, I guess. It's generally kind of at that point, if you're doing large buildings, that type of thing, this is really your only option. And Julie, feel free to scream at me again. But Tim, I know you started your career, like I said, even with the smaller stuff with commercial. So what are your thoughts on commercial?
Yeah, we love it. We started in small town Kentucky and just kind of did exactly what you said. We walked into several banks and created relationships, and it was very much that kind of a thing where they pretty much more lended off of how much they trusted us versus a whole bunch of paperwork. And we started off small with them and kept building a rapport, and it just got to the point where when I want to buy a house in Kentucky, that's my last phone call. So I buy the house first and then call the bank and he gives me the money. And it's like 5 papers to sign and really quick and easy and awesome. And I've done all these other types of loans as well now since then, but that's definitely, we started with that way, and we still use those, with our stuff that we do in Kentucky. So it's really easy, and, we will probably, build some more of those relationships now in other areas now that we don't live in Kentucky anymore. But
yeah, downside of commercial is that you're really only going to get about 520, which is 5-year fixed and a 20-year AM. So it's like a 20-year mortgage. And after 5 years, the rate will likely reset at whatever the market rate is. So the rate and the terms are not great. And also, creating this relationship with these banks is difficult. You might have to call 20 or 30 banks to get to the point where you're having a decent relationship with.
But once you get it, though, it's just like you said, you're in. Then I mean, you got the guy's cell phone number, and it's just, like I said, it's a phone call away to buy a house.
Absolutely. I don't know that it's necessarily short-term friendly. Like, it's probably not. If you're going to be doing the shop model, the way we do things around here is probably not what you're really interested in. And a lot of times I think a commercial bank is going to be like, what the hell are you talking about, Verbo? What is Verbo? We don't know what that is. No, we don't want to do that loan. But as far as real estate investing is concerned, it is obviously a big part of the business. So now we move on to DSCR, which I personally, honestly know very little about, as you know, because Julie already yelled at me. So, which she's good at. And I appreciate that, but I'll just turn this over to Brenna. To me, this as an investor, again, this is sort of a hybrid between a commercial loan and a conventional loan. You get 30-year fixed, but less paperwork, and I'll let Brenna take it from there.
Yeah, so this is an awesome product, like awesome. And we're even finding, we have a loan product that you can do 15% down, which is the same as like a conventional investment, which is crazy. What it does is a debt service coverage ratio loan does not go off of your income or your personal debt. It goes off of the property that you are purchasing's projected gross rental income per month and the property's proposed PITI, principal, interest, taxes, and insurance. So the 15% down rule usually is just like a 1-to-1 ratio. And what that means is as long as your mortgage payment per month is $4,000, then as long as you are producing, or it's projected to produce $4,000 in gross rental income that month or more, then that's a 1-to-1 ratio. And it's a great product. You don't, some products, DSCR, you don't have to have any prior investing experience. You do go off of your credit score and your credit report, but that's literally the only thing that they're monitoring for you personally, as well as your assets for the down payment. You can close that one in an LLC as well. It's kind of like a commercial hybrid. So you can do your personal name or in an LLC's name. I can't speak enough about it. It's a great product. I'm really surprised that it's like that simple to get something. So you will see a little bit of a higher interest rate, which you might be sticker shocked at first. But if you're actually thinking about this company lending you a lot of money on not even qualifying you off of personal income or debt, it's a crazy, amazing product. You do want to make sure you're working with a lender, though, that understands short-term rental income. Because what sometimes will happen is a lender will say, yeah, I can do this loan for you. And they're looking at like an $800,000 cabin here, and they get the rental income back, and they're doing it off of long-term rental income, which is completely different than short-term rental income. So you want to do your due diligence and say, how do you get your rental income? I think I saw earlier, like, what if it's a new construction and there's no previous rental income, or what if it was poorly managed? That's totally fine. We take comps around that property. So if it's like a 3-bed, 3-bath, we look at 3-bed, 3 baths with the same type of view. We see what those have been doing for the last year or so. And then we take the average of that number. So all the areas that we specialize in, you're probably never going to run into a problem of hitting that debt service coverage ratio. And again, that's why it's such a great product.
And DTI, no, not an issue here. In other words, if I'm brand new and I bought 6 properties in my first year and my day job's not keeping up with that, which is debt to income, that's not an issue here, correct?
Yeah, and if you're wanting, it's great for anybody wanting to expand quickly. I see all the time, I see on Facebook, or people ask me, well, my debt to income is capped. So how are all these people getting properties, this type of mortgage? They're either doing hard money or this type of mortgage, which this type of mortgage is what you want to go with. You can scale quickly. It doesn't go off. Let's say you change from W-2 to 1099 and you can't get that conventional loan, or you have 10 finance properties, you can't get that conventional loan, or your just debt to income is strapped for the year until you can file that tax return and show rental income on it. So yeah, it's a great product for everybody.
So Brenna, you mentioned hard money. Like, I'm really glad you brought that up, because I would like to cover that topic. What is? I'll take it from my end, and then we can pass. If anybody wants to raise their hand on the panel, more than welcome to bring that up. Where's that echo coming from? Was that me? Check. I think it's gone. Anyway, so hard money. There it was again. Hard money is literally borrowing money from a dude, like, and it comes in handy with burrs, right? So if you want to do a burr and you're like, hey, I need the cash to, because you usually need to buy a burr like cash up front and then finance it later. That's the whole point. So you're literally going to like I mean, these people are very easy to find at RIAs. Generally, there's like the hard money guy at the local RIA, and you get like your hand. This is my experience with it anyway. You shake the dude's hand and say, "Hey, I found this deal. I want to flip it. Let's, how much are you doing on hard money right now?" And it's usually a ridiculous amount of interest, but it should be because he's taking a lot of risk on hard money. So anybody on the panel have a specific? I've never actually done it. So if anybody here has experience with hard money, love to hear from you. I believe Derek has.
I used private money, which is basically the same thing. Mine wasn't an official lender. It was somebody that had a really big bank account, and he was willing to, it was a friend of mine, he was willing to finance it. Yeah, I paid like 9% interest and 3 points on it. But, hard money gives you an opportunity to get into something. It's got to be a value add situation. You've got to have a plan to refinance or sell to get out of it. So it's ideal for flips and burrs, like Luke said. I mean, that's the idea behind it, but it's expensive money. But again, it's opportunity, right? Where if you don't have any other opportunity to do it, I did it for a flip and I did it for my first ever burr. Both of those made me a crap load of money, even with those high interest rates. So it's just another tool in the tool belt. It's another opportunity, but not something you're going to see in the short-term rental market, unless you do find something that's a total rehab project that maybe it makes sense to do.
Not likely to happen in one of our markets is what.
Yeah.
And Derek, what do you mean I made a crap load of money on that? I mean, because I was there and I saw, how much work you did. So let's be real. You really got to arm yourself with a whole lot of knowledge before you go into that to get that crap load.
Yeah. I mean, to be realistic, that very first one, I put a lot of sweat equity in that, but it was my first ever investment. It was a learning opportunity. If you listen to enough podcasts, that first one is about learning. So for my first investment, I walked away from that deal after the refinance with $5,000 left in the deal. And I'm renting that house out for $1,800 a month. I've just finished my second year, or about to finish my second year on that lease. The mortgage is going up, or the payment's going up to $1,900 effective in January. My mortgage payment on that property is like $847. So, and I've had zero maintenance out of it in 2 years. So when I say crap load compared to SDRs, it's not a crap load of money. It's a little bit of cash flow, but it's nice and steady. And I've got this great little asset. The flip I profited about, 50 grand on that flip, even after my hard money. And that was about 6 months worth of work. And that one I did not do hardly anything. Like I went there a couple of nights because I just needed to vent my head and did some work, but that was more about me just needing something to do. So that one I did make money without putting sweat equity in. So, and yeah, it's just another opportunity. I mean, it's just, you got to look at all the options, right?
Where do we get the knowledge to learn it, to get the guts to do something like that?
Well, I had this guy named Luke who was riding my ass constantly, but no, I mean, bigger pockets. I went back literally. I know that's what Luke's listening for. I went back to episode 1 when Luke introduced me to podcast and bigger pockets. And I had this like V8 moment, right? Wow, what have I been doing? Listen to Rich Dad Poor Dad. I went back to Bigger Pockets episode 1 and I listened to every single episode through the, now of course there's a lot more now than there was 5 years ago when I started. But even though the stuff that we're talking about wasn't relevant to what was happening in today's market, it was just amazing to hear all the different stories and all the different aspects of it. So, I mean, if you're going to get serious and if you're going to go from being a W-2 employee to being full-time real estate in 2.5 years, like I did, and to be very successful at it and to have 15 properties in that short period of time, you're not going to do that just because you decided to do it. I mean, I invested a lot of time and effort into learning and listening to the people that knew more than me, going to RIAs. I started my own meetup. I've got the longest running same host meetup in Knoxville right now. We've been meeting since October of 2018. We have not missed, what we kind of hybrid in the winter, but we have not missed a meetup in 3 years now. So, you got to get in there and do it.
Absolutely. I love it.
Surround yourself with people crazier than you.
It's your 10,000 hours is what you got to put in there. And like what Tim just said, if you want to fly with the Eagles, don't swim with the Ducks. And Chuck, you had your hand up there. What do you have, brother?
Yeah, I did. There's actually other cases where hard money can come in handy in this business. And that is, I'm sure people out here have lost deals to cash offers. I work with a couple hard money lenders I've set up lines of credit with that if I wanted to, I can walk right in and make a cash offer, close in 20 days. We just picked up a property a couple months ago, Miramar Beach, doing that. We offered less than the best bid out there, but we closed in 20 days. They don't even do an appraisal. They do a drive-by. They have a local inspector do a drive-by. Now, the disadvantages are you got to be buying at about 70% or so of what they determine to be the value, either now or after you're finished. The other thing is that these loans are usually only set up for 12, maybe 18. Occasionally, you'll find one for 24 months. So the idea is to use this, get in, get your property that you can't get otherwise, like maybe in the Smokies. And then once you're in it, start working on your refinance. There's no cooling off period. You can go ahead and refinance most of these hard money loans within 2 or 3 months, which is about how long it'll take you. And it's going to cost you a little extra. But how many times do we go in and offer 5 or 10% over the asking price to begin with? It's not going to work in every circumstance, but they do come along. I mean, the place that we have in Miramar, when we're done, it is a fixer. In our case, we're using it to fix it up, but it didn't have to be. We could have put it right on the market and been done great with it. I just want to do better than great.
And that's why you're one of the only guys I will take advice from, because this guy, you've been around for a long time and you're a rock star, and I appreciate that. Okay, one more thing I want to touch on, and then unless Brenna has anything that I forgot, which is the word jumbo. You hear this word a lot, which is obviously anything over 647-200. It is very confusing, especially when you're new. Like, what the hell? What's the difference? What is a jumbo? So just generally, can you briefly touch on what is it, Brenna?
It's awesome because you can put a lot, like little money down for these jumbos. If you go to one of Avery or Luke's classes, they will tell you that, yes, you will cash flow more when you have a larger property, which when you get a larger property costs more. So it's a loan over 647.2. So remember, the 647.2 is our conforming loan limit. Anything over that is jumbo. We still underwrite to Fannie Mae guidelines, but you can put as little as 10.01%. I don't know why it's 0.1. I just have to throw it in there and let you guys know that, up to a $3 million loan amount, which is ridiculous.
And that jumbo loan limit, y'all, is the loan value, not the purchase price. So the loan amount. Correct.
Yeah. So we're talking about like loan amount. So anything that you're getting a loan on over 647,200. So your second home loan, you can do like that little as 10.01% down. And then you can do 20% down investment only jumbo. However, if you do not have 20% down, you can always do that DSCR loan for the investment property with just 15% down, because you can do that 15% down up to a $1.5 million loan amount. So there are great options for you guys either way. Jumbo loans seem to be like, people are scared of them for some reason. I think it's just a common misconception. They're underwritten just like conventional. We go off of Fannie Mae guidelines. They're not any more strict. They're not any more lenient. Interest rate might be a little higher, maybe by like 0.25%, but that's nothing, compared to the long run of cash flow that you're going to get.
Wonderful, wonderful. So we're going to open it up for Q&A. I do want to try and get everybody out of here on time. Avery, if you want to, I know you had at least 1 or 2 questions that you already were fielding there in the chat. And anyway, hope you guys enjoyed. We'll go ahead and take some questions. Avery, did I lose you? Are you there?
No, I'm here.
Okay, go ahead.
Okay, Brian in the chat, do you want to clarify your question out loud, and I will try my best to answer it?
Okay. Hi, Avery. This is Brian.
Hey.
I'm good. Okay. So I was looking at the real estate side, or the agent side. How can they help us? Like, can they guide us through the market in the area that we're in to know what kind of, the loans and kind of the market conditions and what's going on to help us get this loan to get approved and get this thing done? I know the mortgage shop, so, is definitely a benefit to us, right? Because we have a captured audience of this helping us get these transactions done. But just overall, working with the agent side, what can we expect from them to help us through this process?
In terms of financing, so, I think the answer to that is there's not that much they can really help you with in terms of helping you choose which mortgage is going to be best for your situation, because there's just, what your entire financial and like just life goals are is just something that is unknowable to anyone but you.
Right.
But they can help you with things like appraisal gaps and, having to go over asking and, knowing when that has to be done, and getting through that process in terms of what you need to offer. And so that will help you understand what you need out of your loan product. But I guess it just depends really more on what your goals are, what type of loan product you get, than necessarily what any of the agents can help you with.
Mm-hmm. Yeah, I get it. Okay. Yeah, the agent side is really helpful on that market because I don't know the market because I'm so far away from there.
Mm-hmm.
So just knowing to work with that agent closely so that we can put the deal together and make it work.
Yeah, absolutely. And all the agents in all of our markets, they do a lot of deals. So they've seen a lot and seen what works and doesn't work. So they'll all have advice on the specific situation when you're offering on something.
Which I suppose I should clarify, Brian is, I think, referring to the short-term shop, which has not been mentioned yet. We are all part of the short-term shop, which is a team of badass real estate agents, and anybody can check us out at theshorttermshop.com.
Well, I'll jump in on that too, as far as, how much advice your agent can give you. One thing I'm going to say is whenever you put an offer in, there's a piece of paper that you sign that lists all the things that as a real estate agent, we are not. It's a disclaimer that you have to sign. And right in there, it tells you that, we are not giving you any legal advice on any of that stuff. Now, do we have personal experience? Can we give you an opinion just like your Uncle Bob can? Yeah, we can. We may have a little more knowledge than Uncle Bob, but bottom line is no matter what we tell you, trust but verify, because we are not experts in that. I cannot give you lending advice like Brenna can because I don't have that training, but we can certainly give you our opinions and ideas, but we're not true experts on it. But we probably have more knowledge than the average person.
Right.
The mortgage shop lenders or loan originators and the short-term shop realtors together, or like, do you remember like in the older day, I'm telling my age, but like back in the Power Ranger days, and like they put all their rings in together in the little center circle, and then they united or whatever. That's us for you as a package deal.
Awesome. I love that. I
yeah.
want to put my ring in the pool too.
Well, so listen, I guess I'm more of a Ninja Turtle at that point then. Avery, who's next?
Let's grab Candy. So, Candy, tell me about doing your own analysis. Can you clarify that question a little bit?
Well, I was doing I don't even know if I did it right. I tried to follow what I've learned going to the data that you gave me through what is AirDNA.
Mm-hmm.
So I did all of that stuff, but I still don't know if I did it right. But either way, I went on and put an offer on a property because it seemed right. It looked like my numbers were right. Mm-hmm. And yeah, I still don't know if I did it exactly the way that I was supposed to do it.
Well, that's good. So yeah, that's actually something to clarify too. So you did that exactly right. It is your job to do your own analysis and make sure that the numbers work. But if you are like really terrified, you can always email Luke or myself and we'll take a look at your analysis for you. I mean, not like every day on every single property, because we do have to get through our lives as well. But like, if you're just really stuck on something, like really scared to make a mistake, Luke and I are happy to take a look at that kind of stuff to help you through, because we don't want you to be scared. We want you to feel confident. So we're happy to help with that.
Okay, I do have one last question too.
Okay.
So I am under contract now, going through the process of inspection and all of that stuff. I don't know what to do next. Like I'm looking, I'm looking to, figure out, what kind of things that I need for the property and what I need to do, but I'm not 100% sure exactly what I should be doing. How do I get some sort of assistance, and can I get some sort of assistance?
Yeah. So you're just trying to figure out like what things on the inspection report are normal to all properties, or what things you might want to have you ask if you can have addressed or money off kind of thing?
No, this is once everything is done and I've actually purchased the property. Like, how do I run this thing? How do I get it up and running?
Oh, gotcha. So are you a short-term shop client or are you using one of our agents?
Yes.
Okay, then you'll get a link. You should get a link to Luke's Management Monday class and he'll teach you all of that stuff. So you
We
don't have
got
to
you
worry about it.
covered, Candy. Don't
Yeah.
worry about that whatsoever. We're gonna get you taken care of. We definitely want to talk about focus on lending today, if at all possible, because we're gonna post this on
Yeah.
our Facebook. But Avery,
Yeah,
I
we
think
got you
Josh
covered.
has something.
Thank
Yeah.
you.
Yes,
Josh M was first, I think. Thank you for changing it to an initial because it was two
Sure.
Joshes.
Thanks for doing this. I have a question. I have 170,000 equity in my primary residence. I'm looking to do my first STR deal. I also have a friend that'll do a down payment. I didn't know which loan I should go with or what you would recommend. I didn't know if I should refi and pull cash out or do a partner. My goal is to scale to about 10 STRs. So I didn't know what you would recommend on something like that.
Okay.
Money.
Excellent. I'm glad you asked that. If you don't mind, we should definitely cover the partnership question. So, Avery, do you have some advice on folks that are looking to partner when it comes, especially lending related, of course?
Yeah. So, I mean, the easiest way, I guess I'm going to make an assumption that you need a partner because you don't have the down payment or you don't have the DTI or something like that. So the most typical partnership structure in short-term rental is the sweat equity guy, money guy partnership. So money guy puts the loan in their name. They're making the down payment and then you're doing all the management of the property and splitting it 50-50. The way Luke and I did it, we had two partnerships or one partnership on two different properties when we first started. So we had our partner put the loan in his name, make the entire down payment. We split 50-50, but on top of our half of the 50-50, we had a little mini mortgage that we paid him monthly out of our half until we got to cover what our half of the down payment would have been. And then we went to a straight 50-50.
So in other words, literally every detail was 50-50. But also let me touch on that. If you're trying to do this at scale and repeat that over and over and over again, it's not really, in my opinion, doesn't really belong in short term. If you want to partner a few times and do a few large properties, I think that's an awesome idea. But keep in mind that syndication is definitely really not going to work in short term because it is a single family home that needs to be appraised. So if you're interested in that, absolutely go for it. I can recommend a podcast called Multifamily Investor Nation, Dan Hanford. He's awesome. I don't even know if we answered Josh's question, which was an excellent question. Definitely kind of steered that in a different direction if he wants to. And it looks like Patrick had something.
Sure.
Luke,
Just
I'm gonna-
which way would I don't prefer a partner because I think it'll slow down my scaling. If I didn't know if I should refi and pull cash out for my first down, I don't know how that'll affect debt to income ratio.
That's Brenna.
So, okay. First off, let's cover the refinance. So this is for anybody on the call that has equity in their primary or equity in whatever homes they own. So of course we want your refinance business, but is it right for you to what you want to do? So that's what it comes back as we talk to you about your short-term goals and your long-term goals. If you're wanting to expand your portfolio of property, what would make sense would probably be a HELOC for you because it's a revolving line of credit and you can pull from it like a credit card, right? You can pay it off and then pull from it. A refinance is one and done. So if you're just wanting to do one property, then that might be it. You can still get a good interest rate. But once you use those funds, you won't have those funds anymore. Refinances also have closing costs as opposed to HELOCs most of the time do not. And so I would recommend looking in with your local bank that you have a relationship with and possibly look into a HELOC instead of that refinance if you are wanting to scale and grow your long-term real estate wealth.
Totally agree, especially on a primary. Absolutely no reason not to do HELOC on the primary. Wonderful idea. Patrick, did you have something?
Yeah, I was just going to point out, if you do partner with somebody, make sure you get it set up in an LLC with a good operating agreement, because that's going to be your divorce strategy in a business divorce in case something goes bad. So make sure you get an attorney to set that up for you. Don't go to a Rocket Lawyer or one of these other websites that'll set up something that's not state specific. Okay.
Okay, thanks a lot.
Yes, sir. Avery, you want to keep steering the ship? A couple more questions?
Sorry, Josh, regular Josh with no initial.
So quick backstory, my wife and I flipped about 12 homes in the last couple of years. We'd flipped a few on our own, and things were going really well. A partner of ours who's a family friend saw how well we were doing, how much money we were making, and he wanted to get involved and make some money too. So we made him a few $100,000 over the last couple of years working with him. And he's potentially interested in partnering with us on short-term rentals. He's a little bit apprehensive because he doesn't want to carry a lot of debt. And I know, Avery, you said that you have seen just about everything, out there as far as lending and purchasing goes. So we're trying to figure out how we can leverage the relationship and the good past performance that we have with him in a creative way to where he's not carrying hundreds or millions of dollars in debt. So I'm just kind of curious what options there are. Whether you've seen people do, where the money partner will help pay for the down payment or something like that, just so where he's not going to be owing, having millions of dollars in debt in his name.
So like actually partnering just 50-50 on everything. Like you're both going on the loan, you're both going on the title, all that.
No, because we have the money to do a couple of short-term rentals on our own. But we don't have the money to do, we'd like to be at 10 as soon as possible.
So if you don't need a partner, I would probably just truck along on your own, because what happens with partnerships is it ends up like once you get 3 or 4 on your own, which it sounds like you can get at least a couple on your own, you're gonna look at that cash flow, and then you're gonna look at the cash flow of having to split it 50-50 with a partner and be like, why the hell did I do this? I could have just waited a few months and gotten this cash flow together on my own for a new down payment for something else. So, I mean, I know there were a few times that Luke and I, with our partnership, we were like, oh, there's not a lot of meat on the bone here, but we're just getting started and we're bootstrapping and we're cool with that. But if you don't have to do it, then it'll happen faster on your own than you think it will.
Okay. I 100% agree. I think, Josh, focus on the money that you already said you can get a couple of these on your own. Do that, because it's going to, if you buy 1 or 2 or 3 of these things, you're going to blink your eye and it's going to be a year gone, because you focused all you went to that Home Depot and the Lowe's and Chuck's Diner 8,000 times, and then in 12 months, once you've used those up, it's not like a single family for $100,000 where you just put a tenant in it and you forget about it. This thing's going to take it's going to be consuming if you do 3 at once, and not consuming because it has to be, consuming because you are going to be obsessed and really like it. Everybody falls in love with this asset class. They do. And obsessed is a good thing to be. 100% agree with Avery. I think she nailed it.
Okay.
What do you think? I think this is a great topic. Julie, you're up there smiling. I'd love to hear from you.
I'm looking at the chat.
Okay.
But I am of the school of thought where if you're going to be splitting 50-50, that means you got to do twice as many to make the same amount of money. So better do 5 on your own. 5 on your own is the same as 10 with a partner.
And I totally understand that I'd rather have 50% of a deal than 0% of no deal. 100% understand that. But short term is just a different beast. You know what I mean? It's just a whole different animal. And again, we might be having a different conversation if you didn't already say you could get 2 or 3 on your own. So you've got an awesome journey ahead of you right now without the other gentleman, I think.
Well,
Okay.
Josh, I would point out that if he wants to put money somewhere because he doesn't want it just sitting there, maybe you take that as a loan, grab his money, and then buy more deals, and then have a promissory note to pay him back that's not subject to a mortgage. It's an unsecured promissory note.
It's a good idea. I like that. It's definitely a good option. And the HELOC. I guess one really quick thing on the HELOC, are there fixed HELOCs? Because I know interest rates are at historic lows, and they're probably only going to go up from here. So does anyone know if there's fixed rate HELOCs? There
is, but the interest rate will be higher on those.
Sure.
Basically, banks are doing what with the HELOC? They're trying to make money off of you. So the adjustable is going to make them more money if rates go up and stuff like that. And so a fixed is more permanent, and they will make the interest rate higher because of that.
And I really wouldn't worry too much about that, because the whole idea behind a HELOC is to, you really kind of want to do your best to pay it off as soon as possible, because then you can use it again. So it's in your best interest to not be deploying that money and paying that interest all the time. You're trying to repeat it as much as possible. I think you got a great journey ahead of you, Josh. You really do.
I'm looking forward to it.
Yeah.
Another piece of advice. Sorry, Brenna, go ahead.
I was just going to say, don't be scared of interest rates for DSCR. If you're looking at an investment only and it's in 5%, or I'm telling you guys, money right now is the cheapest it has ever been. 3% is not high. 4% is not high. Think about back in 2007 and 2008. If you followed the market then, and when the market crashed, people had like 13% interest rates. And I promise you, like these properties, like you can have like an 8% interest rate and still cash flow. It just depends on your personal goal of how much percentage you want to cash flow. So don't let that interest rate scare you, because if you're looking at a 5% compared to a 5.25, your difference in payment might be like $50 a month.
I still have loans from when Avery and I first started that were regular old low interest conventionals, but back then they were 6+%, and I still have them. I don't even care. I don't have time to refinance them. Just get your hands dirty and get going. Avery, go ahead.
Okay, we'll grab one more. Ash.
Hey guys, thanks for taking my question. I know as I look for properties in Smokies, it's like a crazy market right now, and by the time I do analysis, it's already gone. So one of the biggest question I had here was that anytime I look at a property, I'm looking at how much it was previously sold for. If you look at it in January, it was sold for one, and then all of a sudden in September, it was for another price. And now in December, it's again put on the market for $200,000 more. How does that get really appraised? And which type of loan do we go for that? Because that's the one scares me away from, like, wait a minute, how can this same property go up almost, 100% in 1 year, or and get appraised easily like that? And then which loans should I be looking at to do that? So that's like slowing me down from making my decisions on which way to go.
So
yeah. Oh, go ahead, Julie.
Avery, do you want to take it?
No, you go first.
Well, I was going to say the past sale price of the property does not matter. What the appraiser is going to be looking at, and the appraiser is the appraiser regardless of what type of loan you have. The appraiser is going to be looking at recently sold comps. So it's going to be looking for similar properties that have sold very recently in the same general area. And that's what the appraiser is looking at. That's what they're basing the value off of. The market here has gone up very rapidly. And a lot of people are capitalizing on that by selling homes that they've bought previously, and often are reinvesting that equity into more or larger properties in the same market. I've got quite a few clients who have done and are doing that. So you will make yourself crazy if you look at, what did this property sell for last year? Doesn't matter. Do the numbers make sense right now? That's what matters. If it makes sense for you right now at the price it's available at right now, then great, go for it. But doesn't matter what someone paid for it 2 months ago, 6 months ago, 2 years ago. The appraiser isn't looking at that at all.
Right. So I agree with you. And what I'm trying to figure out is like, okay, if I'm going to pay more for this property, it's going to get appraised because the other properties are going for that per square footage as well. That means I need to now, nightly rate needs to go up.
Mm-hmm.
Nightly rates are absolutely
nightly rates have run up.
Triple. They're triple what they were a year ago. I mean, it's absolutely. We do want to stay on the financing topic. Avery, let's take Melissa, and then we got to roll. Melissa, you were really sweet in the chat, so I definitely want to grab your question.
Thanks, guys. Well, I was just wondering, how soon do people typically pull a HELOC from their home? Because we just bought our primary this year, and I mean, it has appreciated as all people's houses have. But how soon would you do that?
Usually, rule of thumb is 6 months after you own it.
From a bank's perspective, I personally, I don't know that I would do it. It depends on my position as far as like my day job and my kids, how leveraged, because that's like you're pushing it to as leveraged as you can get it if you're HELOCing a brand new house, a new purchase. So I don't think there's a cut and dry answer there. Julie, what do you think?
I'm so sorry, I did not hear the question.
That's okay. Avery, what do you think?
I was hitting somebody in the chat.
Oh my goodness. Did
Okay,
anybody
so
listen? Tim?
It depends on everybody's situation, right? So if you're doing a new construction, you're automatically going to have equity in that. If it depends on where you are, I don't know where you're located, but if you've got 100,000 in equity off the bat from your appraisal, then by all means, but don't strap yourself 100% of equity and like you're just really getting by on that. So just make sure you have set aside for anything that you need to replace in your home. Just keep that a little bit of buffer.
And also, like Derek said in the chat, keep in mind, you don't have to use a HELOC. So I like to always have one, even if I'm not using it. So it's a great plan. But all right, listen, I want to thank everybody. We got to roll. You're awesome. And join us anytime at theshorttermshop.com. And have a great night. Thank you so much for coming.
Thank you, guys.